Good morning, everyone. Welcome. Good to have you all here. I just let everyone connect to audio so that they can hear me. Great. Okay, fantastic. Good to have you guys. Welcome. If you could turn your cameras on as well, please, that would be wonderful. Then we can see you and we can see each other. All right. And just keep your mics muted. That would be good as well. Thanks. Great, guys. If you could just turn your cameras on, please. If you're currently looking at the black screen, just turn your camera on, then we can see you.
Morning,
so good
morning.
Everyone. And welcome. If you could just keep your mics muted for the moment to cut out all the background, that would be great. Hello, everyone. Welcome. It's only 2 weeks ago since we last met. I've just been talking to Maria, and I think when we planned the year out, there was something to do with half term and things like that. So we've got a smaller group today because we only saw each other a couple of weeks ago. And when Maria sent out the email asking for hot seats, challenges, questions, for the very first time in the history of doing this, it came back with a big 0. There was not one single person. So this could be all over in 10 minutes. I hope not, though. So we're going to do this slightly differently. Welcome if you've just joined. It'd be great if you could turn your cameras on, please, so that we can see you. We can see each other. Thank you very much. That would be appreciated. Thank you. So we can do this completely working on what you want to talk about. So we don't need preparation for this. We can jump in with any subject about anything, and all you have to do is raise your hand. I think by now most of you realize where that is. It's at the very bottom of that participants list, I believe. So if you click on that, you'll find that I can see at my end, and we can I can come over to you. So the first was Richard. Good morning, Richard. How are you? If you can unmute yourself for me, please. That's fantastic.
Yes. Good morning, everybody.
Good
morning, Jonathan.
Good morning. Now, I remember the last time we spoke.
Yeah.
You had a degree of progression. Just give us a quick 1 minute backstory.
All right. So I'm building I'm in the process of building a group of digital media companies. I reach out to lots of digital media companies, and the last project I'm working on is a company which is doing digital marketing, especially for internal communication, which I thought was a very interesting niche. Last update, Jonathan, is that turned out I had a meeting with their bookkeeper and my financial guy, and it turned out the numbers were not correct. So the EBITDA numbers he sent from 2021, which is a lot lower than initially he communicated. So
surprise.
Yeah. So we're sort of back to the negotiation table, and I'm not sure if it's a good deal, and that was also sort of the conclusion during the last meeting we had. But there was one big question still hanging, which I really love to have a little bit more insight, also maybe from other people, is what if the owner wants to stay? Is that a scenario which is interesting in the first place? Because I have many cases where the owner wants to stay, so I could do like a 51% deal or a plus.
Well, when you say they want to stay, and you're not saying that they want a job, you're saying that they only want to sell some of the business.
Exactly, but the majority is okay, but they'd like to join a group because they feel on their own they're too small to do good deals and good projects, but they love to be part of a larger group.
Sure.
And they're willing to give up a majority stake. So if that's an interesting option we could pursue, then I have a lot of potential deals which I could do, like maybe even with a sort of swapping structure, you know, that you trade some shares in the group for some shares in their new company. That means there's no money out of pocket, but still you have control over the company. But then the downside then is that they have still insight in what you're doing with the company, what you're doing with the financials. So there's always that person looking over your shoulder, because you have to give them a certain amount of transparency what you're doing with their company. So if you take a lot of cash out of the company, there could be some discussion there, right? So
it depends what your shareholders agreement says. So I realize that you're in the Netherlands, so it is going to be slightly different. But so you obviously need to take your own advice in the Netherlands. But in the UK, you have different classes of shares, and different classes have different rights. And you have a shareholders agreement, and the shareholders agreement is between the shareholders to set out the relationship between the different shareholders, maybe responsibilities, and also what happens should a shareholder wish to leave, and how their shares are valued, and who gets first crack at those shares, and what happens if they want to sell their shares to someone else, and what happens if you don't want to buy them, and all of those different scenarios. And the shareholders agreement is often skimped upon because it's not a very exciting thing to do. In fact, in some ways, it's quite a headache. But when you do skimp on it, it creates massive problems. And I skimped on it once about 10 years ago, and it created problems, massive problems for me. So that's why I feel so strongly about it now. But it would be good to get some other people's input on that.
So the way, and I think in the UK it's the same structure exists, is that you put a part of the shares in a foundation, and then and you'll be the director of the foundation, and then there's share certificates that you give out to the former owners, so they have the economic rights and the economic upside of having share certificates, but they don't have any. You don't have to invite them to a shareholders meeting, etc. But you still have to be transparent about what you're doing and the books, etc., and the numbers.
This is where your corporate lawyer can guide you. But as I said, transparency is one thing, but if you control the business, then you can write into the shareholders agreement really, what you can do and what they can't do. Now, in the UK, there's a protection for minority shareholders to stop those minority shareholders being sort of abused in their minority position. But again, you're in a different country, so you'd have to take advantage in your country. But just on the whole sort of concept of keeping people, that's the sort of technical aspect of it. But the whole concept of only buying part of a company, typically you do that. So this is the private equity play, is that they only want to buy 80% because they want to leave you with 20% to motivate you to build the business for them. So in effect, you as the seller are now working for the private equity owner, and that does not suit some people's personalities at all. They do not want to do that, and I understand that. But the other side of the coin is that you have access to cash, and you can grow faster than if you're doing it by yourself. It will certainly be run more professionally than if you were doing it by yourself. And your private equity partner will want to get the very best exit value, and you probably will get a higher exit value because it's a business that's already been invested in by private equity. So it kind of gets the stamp of approval. Like I've been saying to people recently, no one wants to be the first lender. And so I think 51-49 is too close, to be honest. I think they should be down at the 20-25%. Because otherwise it feels like you should be sort of okay, you've got 1% more, 2% more, but you don't want to be debating topics. It needs to be very clearly your business, not a partnership, in my opinion. And that's really a personality thing more than anything. So let's get some other people's opinions on what we have just said. It would be great if you could just, if you're talking about if you want to talk about a different subject, just lower your hand now. And those people who've still got their hands raised, I will ask you to comment on what Richard has just said. So Gillian, first of all, I think. Hi, Gillian. Good morning.
Hello. Good morning. So my experience, even before the actual business, the actual deal's completed, is that when you keep the existing owner, they've already got a relationship with the staff. They also have this quite hard mindset to transfer from the fact that it's not their business anymore, and they do want to actually dictate where the business is going, because they've been running it for quite a while, and they just can't really grasp your concept or your direction. So I think it's a minefield, basically. It's okay to keep them on for 6 months or something like that for a transition period, because you're still very much learning from them, and you can take their advice as such. But after that, it could become quite a headache for you, and every change you want to make will be an uphill battle.
Yeah, good perspective, Gillian. Yeah, absolutely. Sometimes the fastest way to success in a business is actually to remove the owner. That is the quickest way of doing it. I can see that Richard's coming at it from a more collaborative perspective, where he wants them to continue running the business and building the business and be motivated to do so. So I think it is partly personalities, and it's partly the type of business as well. Thanks very much for that input, Jim. That's really good, actually. And Rob, good morning.
Good morning to you, Jonathan, and everyone. Yeah, it's a bit like Gillian's point. I mean, from most of the people I know who are small business owners, and most of the people I've spoken to, the small business owner is a control freak, and selling you part of the business doesn't stop them being a control freak. I'd be interested to know if anyone, Jonathan or anyone else, has actually experienced something where they have purchased a business and retained the owner, and what they've actually found in that. But that was my question, really, around what's the attitude of the owner at the moment. Does he look like he or she is a control freak? And
in the short term, they might want rescuing. They might want rescuing in that they've lost their way, and they think that this is the way to get some direction back. They might feel as though they want a partner. They want someone to talk to and bounce ideas off of, and that might be the furthest thing from your mind. The last thing you want to do is be chatting with someone about it, and then of course when they feel they don't need you anymore, business starts to move upwards. They got the focus back. They got rid of the toxic members of staff. They don't need you anymore, and they're stuck with you. Now, you might have in your shareholders agreement the ability for them to buy you out at a greater value than what. So that might be quite an interesting. They might pay you off effectively. Great for that, Rob. Thank you. And Tim.
Yeah. Hi everyone. Hi, Jonathan. I sort of look at it from a different point of view. I think if keeping them on, if you think most of your value is going to come from your mass and the size that you're having, and if they're just like a little standalone entity that would only get a 2-3 times multiple at whatever EBITDA they currently are at, and then you bring them into the group, you're going to be giving them a load of money technically on exit that they've not really earned, if that makes sense, because they're going to benefit from your scale of economy and your higher multiples. If you were going to do it, and I don't like the idea of it, you could say, for example, let's say the sector dictates that they'll get a 3 times multiple at their size. You could offer them a 4 by joining your group, but they don't get paid until the sale. And then you keep anything above the 4, if that makes sense. So let's say you sell for an 8, you keep the 4. So they're getting a little bit of benefit from your size, but you're not giving them everything, because they don't really deserve it, if you see what I mean. We're doing something at the minute. We've got 2 companies that we're working on, and 2 of there's multiple directors, and one owner in each of the companies wants to stay on for a little bit. I think the others are forcing them to sell, basically, and we're putting them on something like this is what we're thinking. is we're putting them on a base, on a contract agreement, a base salary, but quite a lucrative commissions, and all they're doing is sales, and we can get rid of them within a couple of weeks. And all they like I said, they're getting rewarded by the number of jobs they're bringing in. So they're not really meeting the staff anymore. They're literally just going to find new customers. And then we have, like I said, we have the flexibility of a short-term notice just to get rid of them if they're not working. And then if they work, we get loads of sales and they sort of pay for themselves. And if they don't, we just chop them and then they're gone. So that's something, rather than giving them buy the shares, but then maybe you could give them like quite a, because at the end of the day, money generally speaks. And if you give them quite a lucrative package, but a performance related package, there's almost no risk potentially.
Yeah. The fact that there's some sort of earnout, well, it is an earnout, isn't it?
Yeah.
And Tim also really touches on a very good point in that let's say you buy for 3 times, but the group is worth 8-9 times on exit. That exit value has been determined by the work that you've done, Richard, going around and finding all these other businesses. So they are benefiting for something that they haven't done. They've just carried on doing what they're doing. But there may be, as Tim said, some sort of incentive in there where you don't actually. So the example that I've used before is Hakim Group, and Hakim Group, Hakim. Hakim Group is run by a very entrepreneurial chap who has. Who started buying opticians, and I've only ever spoken to him once, and he took investment from a private equity firm, and at the point of investment, he'd bought 80 opticians, and the last time I saw, which was a few weeks ago, it was now up to 280, which shows what some private equity capital can really do to accelerate growth. And his original model, it may well have changed, but his original model was he'd come in to own 50% for nothing, but the optician who isn't interested in marketing, who isn't interested in doesn't have the ability to get any real scale when it comes to purchasing frames and all the things that you have in an optician's, you could now get that as being part of the group. But to access the group and get the access to the marketing support and all of those things, you have to give up roughly half of your company. And it was a very solid model, and he got I'm not there's no sort of I'm giving you very rough numbers, so I'm not breaching any confidences, but he got an 8-figure sum personally on that private equity deal. He was able to cash out eight figures for selling some of his shares to the guys.
Yeah. All right. Thanks for the insights. It makes me think. I sold my company before, and actually it was a digital marketing company, but it's a long time ago. And I had to stay for 3 years at the time, so I had to sign. I had a lockup in my. It was a share transfer, and I know that it took me about 6 months to realize I wasn't the owner anymore, because in the beginning everything was the same, but then they started to take all these decisions over my head, and. So I know how it is from the other side as well.
Okay. And finally on this subject, Patrick, contributing to this subject here.
Yeah, Jonathan, it was just an observation really that kind of builds on what you said a few comments ago, and I don't know if it's strictly an English or British thing, but the last 4 serious conversations I've had, out of the last 4, 3 of them, when we eventually got to the point where we talked about, they said, well, what's your vision? And when I would kind of wave my arms about and lay the vision out, that seemed to quite energize them. And those 3 out of 4 then came back and said at that point, they would actually really prefer to stay on for various lengths of time, whether it was as part owner or when I said that would be out of it, they would say, well, we'd like to stay involved as consultants or even employees. And the one that I'm doing right now, hopefully that I can get across the line or get the heads of terms done, they seem to really have grabbed onto that. Is you know, we like what you're doing. It's almost like I wouldn't give them this idea, but it's almost like they should go out and hire a managing director and do this stuff. It's almost, that's what they're looking at me to do, is to come in and sort things out from it. It's just an observation, and I don't know if that's useful.
Yeah, that's exactly what I have. So we made a nice mission and vision, and has some very interesting goals there, and they relate to this, so they want to be part of it. And but also what I found is lots of them, they'd like to have a coaching person around them, because it's quite lonely as an entrepreneur. Some of them are alone, or the two of them. So they love to have conversations. My conversations actually never stick to half an hour. I never can do this. It's always longer than an hour, because I have a lot of experience, and I like most of the people I talk to. So maybe that's also why they want to be part of the group.
Yeah, I mean, it's really working out where you want to go and what the best route is to get there. That's, isn't it? So it's going to be different for everyone. And yeah, if you need to mobilize the current owners to carry on for the next 3 years and incentivize them for doing so, and they get a bigger share of the exit than they would have done if they were by themselves, maybe there's an opportunity to take control of the business without having to pay anything, or to buy part of the business with the option to buy the other part for a pre-agreed price, which is obviously easier to finance once you own it. So if you feel like that there's the possibility of a larger exit, you could actually borrow the money to buy those owners out, because you know that in 6 months' time there's a far bigger number at the the other end, possibly. Gila, good morning. Oh, just unmute yourself.
Yeah, no worries. Good morning. Yeah, so there, from my opinion, two aspects. One is your goal, and the second one is the seller goal. If they really want to stay in the business, you have to, this is just my personal opinion, you have to find out why they are looking to stay in the business. And if they need your time to help them out with, I don't know, with marketing, with growing their business, I will charge them a consultancy fee, because your time is more important. Yeah, and in that way, their business will grow and your group will grow. But also you should link their exit on their performance. So if they grow the business at a certain level, they will receive this. If they go further, they will receive more. If they go below, then they will receive less money. This is just my opinion.
So if you take, I don't disagree with that. If we take what you've just said and combine it with what Tim was saying earlier, then you could say that the maximum exit value you will receive, for example, is 8 times, but you know that a group of a certain size is getting 13 times. So the uplift, anything above that 8, the maximum they'd get is 8 if they hit all their performance targets. But you could get 13 when you've got a certain size. Yeah. Well, that's and that bit over the 8 is yours.
This must be linked with the performance, otherwise you will not go anywhere.
Yeah, otherwise people become lazy, especially if you've given them some money for their shareholding. They may be sitting now on more money than they've ever had for a while, and it might be tempting to be a little bit lazy and go on that family holiday for a month, and suddenly your new business partner isn't going to who you want to run the business isn't there because they're out spending the money that you've given them. And that is actually, again, that's another private equity concern, is that they do give you too much money and it changes your lifestyle. They're concerned that you're not going to be as committed. The key to this, I think, because I spent a very, very long lunch once convincing Lloyd's Development Capital, LDC, that any money that they give me would not change my lifestyle. And I had to go to extraordinary lengths, I felt, to explain that my lifestyle was quite comfortable. I was okay. It wouldn't make any difference. I don't think I did convince them, but you've got to, if you, the concern, I'm thinking of you guys when you eventually exit at some point in the future, which you will, whether it's in the next few years or in the longer term, you will do that. And it's with a private equity buyer, then their concern is you're going to run off with the money. And as much as you say that you're going to be committed to building the business over the next 3 years, they'll never see you again. So they'll probably have some mechanism to get the money back if you do that. Yeah. Great.
Okay, perfect. Thanks.
Inspiration.
Yeah, absolutely. Yeah, absolutely. Thanks very much for that.
No, pleasure. No, that's great. Right, let's move on to a completely different subject. Who's got something else that they would like us to discuss as a group? Just raise your hand. A different subject. Okay, Steve. Good morning, Steve. You're up there first.
Hello, can you hear me all right?
We can indeed. Yes, go ahead, Steve.
So I'm looking at in the care sector, but I send out a kind of general business to business spam kind of letter, about 1,000 of them, and I've had a really interesting one that's come to me.
Steve, it's not spam. It's not spam.
No, let me take that back. Let me track that word.
Negative connotations.
Yeah, I've had a really interesting one that's came to me, and it's on one of these gastro pubs, like a posh hospitality business. Now it's doing 1.3 million a year. It's fully staffed, it's managed, it's got great reviews on TripAdvisor, it's got 2 rosettes for food, and it's very nice. I went and mystery shopped it yesterday with the missus, and we had lunch there and stuff, and it was really nice. And it's doing 357 net. Now the story is, I initially had a conversation with this lady about a month ago, and she was adamant that she wanted a lump sum and that was the only way, etc. And she texted me about 3 days ago and said, circumstances have changed. I need to sell this ASAP. Her daughter's just been diagnosed with cancer, and she wants to focus on the family and so forth, which is awful. I get it, but now it's an interesting opportunity for me, I think. But even when we had our one-to-one, Jonathan, I'm still struggling to get my head around this idea of how you buy a sole trader when there's not huge assets to use for leverage, like, massive printing machines and so forth. So I'm just wondering if anybody's got any experience with hospitality sector, first of all. Perhaps who might they go to for lending, and what would be the kind of strategies to finance that? I understand that a lot of the payments are made via card transactions, so there could be an opportunity to use, is it called merchant cash advance for that? So that might be getting me one chunk of money. But how else might people raise the finance as initial consideration? Obviously, I'm going to defer as much as possible, but I'm assuming she's going to want something up front.
Well, why do you assume that?
Because she's already said she wants a lump sum.
Now, that was originally, and then complete change in circumstances, and now it's about speed. She's come back to you, even though you said it's not possible.
Yeah.
So I think your assumption is only that. It's only an assumption. It's not necessarily the fact.
Yeah, understood.
Okay, so let's. Who would like to contribute some help to Steve on that one? When you said about being a sole trader, she's a sole trader with a 1.3 million.
Yeah, I'm finding loads of these, loads of sole traders. Yeah, the best one I found was a 6 million turnover care home in a sole trader, which is just bonkers in my opinion.
I think I've said to you before, I don't understand. I always thought that local authorities would not give contracts to individuals.
There we go.
Yeah. So who'd like to jump in with some comments for Steve, please? I can wait. Who'd like to go? Go for it. Go for it, Tim.
I don't know how you would finance it, but I would, if it's like, this pub, it's all over the news that pubs are shutting down because of utility bills and stuff like that. You could massively leverage that for a performance-related payout. There's talks of, pubs charging £20, and you could say that's your concern, and that's why you can't pay much money up front. And then give you a forecast, and then just link your buyout to the thing, and you could have that done probably quite quickly, and then give her a small chunk as a statement of intent. But you could say the risk is so high, given the fact that that's how you wouldn't want to give her too much money up front anyway for a business like that. It could be a really good buying opportunity in the sector. You could probably get a lot of stuff for not a lot of money, and just leverage the bills and stuff. That's how I would sit it. And I wouldn't want to. You probably wouldn't want to pay them a lot of money up front.
No.
Given that, it's literally all over the news how small businesses are going to be shutting down, or lighting pubs with candles and stuff like that. That's how I would leverage it. And by the sounds, she's probably not going to get. There's going to be lots of other people that are going to be offering something similar. So you could just sort of say, this is how it works at the minute because of the market, and then just sit back and wait, and she'll get more motivated as she goes on.
That's a good point. Thanks, Tim. Appreciate that.
I've always thought. Thank you, Tim. I've always felt with restaurants that it so depends on the chef, and the moment the chef leaves, the customers leave because you can't get a replacement chef that's good enough. So you settle with someone who's not as good, and it just goes downhill. And if you ever eat somewhere on a regular basis and you notice a change in the food, have you ever said to the waiter, have you got a new chef? Because you can tell sometimes, can't you? And
this one's quite a good one because the chef's been there a while. They've got an accommodation that is part of his package, and so he kind of lives on an annex on the building. And
basically, you're saying that if he leaves his job, he's losing his home at the same time.
And they've just had a baby as well, so like he's living in with his partner, and they've got the baby. So I feel like they're going to stick around for quite a bit. But I would want to discuss that as part of the deal, really, keeping him on in some way.
But the things you can't force someone to work for you, so that's the thing. I mean, that's possibly if the chef is outstanding and people go to that location for the quality of the food, not the size of the portions or the low price. They actually go for the quality. Then that's where you could cut someone in for a couple of percent to keep him locked in and closer. Steve, good morning, Steve.
Hello there, Jonathan. Thank you. I'd just like to offer 2 points, if I may, Steve Heald. The first one is that this person's already opened up to you that things have changed and it's a family member who's now got cancer. And I think if you have a sympathetic discussion with the person, and actually we know what she wants, but actually ask the question, how much does she actually need? Now, if it's needed for some medical treatment, you could work on that, because medical treatment's not going to, I don't know how much it's going to cost, but it's certainly not to the equivalent value of an initial consideration. So if her immediate need, let's pick a number, is only £15,000, that's your starting point. Then you can say, well, how do you need it? How often do you need it? Work with them to deliver, maybe on a monthly basis, to serve the needs of the medical part of her situation. So that's my first contribution, right? And then you can work the rest out later. That becomes a business discussion, not a sympathetic, emotional discussion. The second thing is, you said there are not many assets to speak of. A pub that I've got an option on, the owner not long before putting it to the market, have bought all the kitchen equipment brand new, has no debt on it. It's £25,000 worth of kitchen equipment. You could easily get an asset loan on kitchen equipment. So don't underestimate the value of the assets you can't actually readily see. That's just my perspective. Thanks, Jonathan.
No, you're spot on, Steve, on both points. It is actually quite surprising that commercial kitchens can be financed. That was news to me a while ago. I had no idea that was such a financeable asset. But you're absolutely spot on, Steve. And what Steve is saying to you, Steve, is the deal is a collaborative process, as opposed to here's my offer, I don't like it, make another offer type arrangement. And what did you must have talked figures the first time? What was she looking for the first time round?
1.5 million.
And there's no building.
There is a building that, like Steve said, I would be looking to take that on a separate deal, like an option or something. So just buy the business and get in there first of all.
All right. Okay, so what's the split between the building and the business?
We haven't had that discussion yet, because
that's kind of like a critical. That's because that's kind of critical. Just coming back to your very first point about getting your head around buying from a sole trader, it's an asset purchase. No different if you're doing an asset purchase from a company. It's just an asset purchase.
One thing I was thinking about is perhaps get her to look after the incorporation of the business and do all the 2P stuff and whatnot, and then perhaps me come in as a shareholder there and
why would that be advantageous to you?
Because I think my thinking is I can perhaps use her track record of it's been established for many years and it's been quite lucrative. I think the banks might be or some lenders might lend her some cash based on her track record. I don't know if this is true. This is just my thinking. Once she incorporates, so she would be able to perhaps release a loan or something like that, and that would pay her out. Is that how does that?
Yeah, I'm not sure about that. Let me have a think about that whilst we move across to Alison. Hi, Alison. Good morning.
Good morning. It's funny, I've actually written down, see what she needs versus what she wants to walk away. I think, though, that the bit that you've just been talking about makes it very messy, because she's come back to you because she likes you and there's already a relationship. So if she might get other offers, she prefers already working with you, but she stated that she wants to go and be with her daughter. So adding in all that other stuff might completely throw her. And your assets, you've got all those tables and chairs, you've just got so many assets in there already that you can probably deal against. By leasing it, you're also giving her a regular, maybe monthly or quarterly rent fee, which again might help with offsetting those bills. So I really love Steve's ideas there of seeing but ask her what she needs to be able to walk away and have that time with a child. And time will be critical now. So she might be looking to do this in weeks, in 2-3 weeks rather than months, because if her daughter's about to hit chemo, then, she'll want to not be there. Her head is already not there.
Yeah. So time's the most valuable asset for her here, isn't it, really?
So I'd be finding out, get a property value and what her mortgage is on the property and what the correct level of rent would be on that property, because it might be that you become her tenant, but you don't pay for the business because of the risk associated with a business like this, for all the things that were said earlier, the utility bills and so forth. So you don't actually pay for the business, you become a tenant, and the rent over and above the mortgage payments is hers. So that which she's not getting at the moment. She has to. This is a new income stream for her, and that income stream would start immediately.
Good idea. Yeah,
maybe that's another way of doing it. There's so many different ways of doing these things. Thank you very much, Alison. Over to you, Richard.
Yeah. So I used to run a long time ago the pub for the student union, and what I learned there is that these pubs are they're financed by the beer companies. I don't know if that's the same in the UK, but you could very well go to the beer company. Maybe there's some contracts there, existing contracts, but they pay for everything. They pay for buildings, they pay for your furniture, they pay for anything as long as you sign up with them for a long time. So I would just find out who they have a contract with and just give them a call and say what your plans are and if they're willing to finance it.
So good. Yeah, great idea.
Okay, thanks.
Yeah, very, very good. Very good. Yeah, thank you, Richard. Lisa, good morning.
Good morning. Welcome, everybody. I've got a very simple question here, but I'm struggling. I'm trying to sort out the EBITDA and the EBITDA margin.
Sorry, just 1 second, Lisa. I didn't realize we were moving on to a different subject. So let me just tie off what we were talking about with Steve, and then I'll come straight back to you. Okay.
Okay.
So Steve, does that give you a bit more to be going on with?
Yeah, definitely. I think I need to sit down with her and have that sympathetic discussion first and have that connection, get what she wants and get an idea of what she wants, and then look at how we can perhaps use some of them assets if she wants an initial consideration. But I like the idea of perhaps renting from her initially.
Yeah, get it. Take a nice long lease with her and say, look, this is going to be your income for the next 20-25 years.
Yeah, good idea.
By the way, you aren't committing for 20-25 years. You just pay as you go, pay the rent as you go, and then the new owner has the benefit of the lease that you've negotiated. And when you said about transferring her sole trader business into a company, I mean, I don't know, but it feels like that might trigger a sort of tax event. It feels like there might be something, but that's where you take a tax accountant's advice.
Okay, that's great.
We get several different opinions from different accountants on that, actually.
Yeah, thanks.
No problem, Steve. Let us know how you get on.
Appreciate it. Thanks, everybody.
No, pleasure. Right. Okay. Lisa, back to you. Start from the beginning, would you?
Okay, I'm having struggled. My weakness is on the accountancy side of things. Sure. And I'm having a struggle with trying to sort out the EBITDA and the margin. And for example, I'm looking at a company where I look at their accounts and to try and determine what their earnings are. In the accounts, there's gross profit, operating profit, profit before interest and tax, profit before taxation, etc. There's so many different figures that I don't know which to start with. And then, as I understand, EBITDA is earnings before interest, tax, etc. So are you taking one of the earnings figures and taking all those others away, or are you adding it? Because it seems to depend which page you look at on Google, whether you're adding them or taking them away.
So let me just explain the purpose of the EBITDA figure. So the earnings, profit effectively, before interest, tax, depreciation, and amortization. So EBITDA is the leveler, is the way of being able to, in theory, compare two businesses by comparing their EBITDA. And the reason that you take this number, which is slightly higher up the balance sheet than net profit, is because accountants can change the amount of tax that is going to be paid by doing various things. Maybe there's a business has taken out a loan and there's interest payments, which are impacting the profitability of the business, but it's not a normal cost to the business. Yeah, it's not the cost of, like in our restaurant example, the cost of the food and the utilities. Interest payments aren't sort of part of that operating in business. So the earnings before interest, tax, depreciation, amortization is this number slightly higher up the P&L, that if you look at this business, you can see this one does 1 million, this one does 500,000. So this one makes twice as much as this one. Now, hopefully I've gone some way to answer your question already, possibly, but the number that you're looking for, if you're looking for EBITDA, is that pre-tax, pre-interest. There'll be a depreciation figure in the accounts, pre that. There's maybe amortization, pre-amortization. All of it's the number higher up than those. So it's a bigger number.
Right, okay. So it's adding the figures, not taking them away then. So you have the gross, no, sorry, the profit after the cost of sales, and then you add the interest, the tax.
Yeah, so you've got your turn. Now I'm not an accountant, remember, please remember. So I'm explaining this in very much layman's language. So you've got your turnover, you've got your income, your revenue, whatever you want to call it. So the money coming in from customers, and then you've got the costs of providing the product or service. That's the COGS, the cost of goods sold. Then you've got your gross profit figure. Okay, and sometimes brokers quote the gross profit figure as a way of making the business look more profitable than it truly is. Yeah, gross profit might be quite interesting to know in some businesses, because you want to know actually how much it costs to provide a product or service. But in some businesses, they put the staff cost, which can be chunky, up in the cost of goods, and sometimes they put it below in operating expenses. So we've got our cost. So it's not a hard and fast rule. So you've got your gross profit, and then you've got your overheads. So this is typically your occupational overhead. So your rent, your business rates, your utilities. It might well have your staff in there, and then you get the next nut. So your profits goes down right to the very bottom. And if you've got a switched on accountant, the idea is that the profit figure that you pay tax on is as small as possible. So what EBITDA does, it gets rid of those crafty accountants' manipulations, gets rid of any interest, for example, that you're paying on loans, and it levels the playing field.
Right. Okay. And then there's this question about EBITDA margin as a percentage.
As a percentage of revenue, yeah. So the EBITDA is, let's say, 20% of turnover.
Right.
So give us context to what you're talking about here.
May I just add a clarificatory comment?
Go for it, David.
So I think to answer the question about whether you're adding back or subtracting, it's worth thinking about whether you're coming from the revenue line down or whether you're working from the net profit, the profit after tax, up. But as Jonathan says, I mean, basically EBIT, it's worth thinking that EBIT, earnings before interest and tax, is often equal to or very close to operating profit. And operating profit is struck, as Jonathan says, after you take off from revenues your cost of goods sold and your operating expenses. And it's an operating profit is before you apply the interest charge and before tax, because the interest charge comes off before the taxable profits are struck, and then tax is paid on that. So that's the sort of basic thing. But what's confusing is that operating expenses often include depreciation, which is the annual sort of accounting charge for a chunk of capital expenditure that you made in the past. And that's a non-cash expense. So what you need to do to get from EBIT to EBITDA is to add back the depreciation charge to your operating profit. You'll find the depreciation charge in a note on the balance sheet, probably. If it's not shown, if it's not itemized as an expense on the income statement, it often isn't. So basically, another way to look at it is you get to EBITDA by starting with your net income or your profit after tax. You add back the tax, you add back the depreciation, and you add back the interest. So that's you're adding back if you're moving up from profit after tax, or you take it in Jonathan's direction, you move down from revenue, you subtract gross profit, operating expenses.
Thank you very much. It was the fact that sometimes you were adding and sometimes you were taking away that I just couldn't understand.
It depends which way you're moving in the in the P&L or the income statement.
So are you starting from the revenue at the top?
Yeah.
Or are you starting with a net profit at the bottom? If you're adding, if it's net profit at the bottom, you're adding, and if it's starting at the top, you're taking off.
Yeah. Thank you very much.
But Lisa, I think it's good to sort of get acquainted with these things without a doubt. But at some point, it's also good to have a trained accountant.
Yeah.
Because it's just easier, isn't it? You know, it's rather than sort of doubting yourself and are you getting it right? Yeah, it's good. It's good to have someone. So give us the context of this. So what is it that you're looking at?
I'm talking to several companies at the moment in the construction sector with the idea of building up a group. So I've got an air conditioning company, a company that does barn conversions, because I'm in East Anglia and there are lots of barns and things like that. And one or two other companies like that, which could join together to make a group. And a lot of these companies are family owned, which that is another problem, because if the next generation is working in the company, I don't really want them in there, do I?
Well, I mean, it comes back to our very first conversation.
Exactly. Yes.
Today, doesn't it? It depends what your angle is. Yeah, absolutely. Barn conversions. That's interesting.
Oh, that's a beautiful well, the work that the company does and the people who work in the company are really nice. Whether it's a profitable company or not, I'm still playing around with the figures, but
yeah, sure. And don't forget, you know, the many owners would tell their accountant, I want to pay as little tax as possible.
Yeah.
You know, you might even have an accountant who actually asks you how much tax you'd like to pay, and then that's what the numbers end up at, which is perfectly legitimate. You may just be sort of deferring tax payments into the future, but yeah, with did you say air conditioning?
Yes.
Yeah, so we've got a masterminder from last year who is doing very well in HVAC, heating. What is it? Heating,
ventilating, and
air conditioning. Yeah, I get my letters in the wrong order. Heating, ventilation, and air conditioning, and he obtained a facility from one of the funders that we introduced people to. I think it was either 3 or 3.5 million to continue his buy and build in that sector. So that kind of validates the sector, if you like.
Yes, but I've had also a company that is owned by someone in the Windows sector, and he has been just putting money in the bank because he doesn't want to pay tax on it. And
what do you
well, he's storing, rather than taking dividends.
Oh, okay. All right.
Yeah.
So it's just left in the business. So he's paying corporation tax on his profits, but he's not drawing the money personally.
He's not, yes. And he has been adamant every time I've spoken to him that he doesn't want to sell to somebody who buys the business with the money that's in the bank. And I think he doesn't understand the tax implications.
Well, that's down to you then to explain
in
such a way that he gets it. But there may well be other people on the session today who might be interested in that type of business.
Right.
If it goes nowhere.
Always get in touch with me.
Say again.
Okay, thank you.
Say it again, Lisa. Yeah, okay, all right. Thanks very much. Patrick, did you have something to comment on what Lisa's been saying?
Yeah, it was just a comment on EBITDA and ascertaining the profitability of a business. And I'm not sure that this is what Lisa had said, but it was just something. Any business that uses a lot of capital assets, depreciation is one of those things where you have to be very careful, because it is. David was absolutely right. It's a non-cash expense, but you just can't get away from paying for new equipment or maintaining equipment or replacing equipment. And it does because something that you do have to add at least probably a portion back, but that'd be industry specific and depending upon how quickly you write down those assets as compared to their useful life. It's just something to be aware of.
Thank you. And let's bear so just to take it back to basics, and again I'm explaining this in very much a layperson's language, is that if you buy that I don't know, that big piece of manufacturing equipment, your accountant might put it into the accounts as being depreciated over 4 years or 5 years. So every year for 4 years, it reduces its value by 25. And then in year 5, if you're doing it over 4 years, it doesn't appear in the balance sheet at all. But that piece of equipment might really have a useful life of 10 years and still have a financeable value. Now, with property, we know that over time, property goes up in value. But sometimes accountants depreciate the property, and the property value goes down in the accounts over time, over a longer period, obviously, than 4 years. But they start to depreciate it, and this is what happened. It's not the most popular example I've used, but this is what happened with British Home Stores, that allowed Sir Philip Green to buy it for 100 million. Okay, 20 million that he borrowed from his friend, and 80 million that he borrowed from the bank, so none of his own money in that 100 million, and then got all the properties revalued by Knight Frank or Savills or someone like that, and then was able to pay out the biggest dividend in British corporate history of 1 billion to his wife in Monaco, because he realized the property portfolio was undervalued in the balance sheet. So when a company owns a property, I'd be asking your accountant to check very carefully to see if that property was being reduced in value or appreciated, as it may be. But if you get a commercial valuation on a property from a surveyor, it might set you back a couple of £1,000 at least. Depends on the size of the property, whether it was there's lots of sites, or whether it's could be an absolutely huge property, or it could be a smaller restaurant, for example. Then I would be keeping that valuation very close to my chest. If the valuation came in a lot higher than the figure that's in the accounts, I'd be keeping it. I'd be keeping it to myself. There might be a nice little hidden upside for you. Does that make sense?
Yeah. Thank you very much for that explanation.
Great, Lisa. Yes, I don't know how eloquent it was, but hopefully between us all, the points have been made. Great. Let's move on to a completely different subject then. Who's got something else, something new, something that we haven't talked about yet? Simon, good morning to you.
Morning, Jonathan.
Morning. What's going on? What's happening?
So we're at heads of terms with a company and have been for about 8 weeks now. Okay. What I'm struggling with is actually getting information out of the seller.
Okay.
So he doesn't seem motivated to provide the information. When we speak to him on the phone, he's very motivated to sell, but actually getting him to do what he needs to do to get to the solicitors seems to be an issue.
Okay. Asset purchase or share purchase?
Share purchase.
Okay. And type of business?
It's a heating company.
Heating company. Okay.
Commercial heating, yeah.
Commercial heating. Okay. Has he given you anything like the level of debtors? So people who owe the business money?
Yeah. So we've been down to do some financial due diligence.
Okay.
But that raised some questions for his accountant. And that's what we're waiting for. We're also waiting to complete the legal pack for the solicitors.
Right. And how big is the business in terms of revenue and profit, just roughly?
About 650 turnover. Profit was about 100.
Okay. Okay. All right. So what is the risk to you? This is a good question for anyone to ask themselves. What is if you bought this business and you didn't know everything about it, what is the risk to you?
For what we're paying for it, there's not a great deal of risk.
Okay. And are you paying for it over a period of time so that
so there's an initial consideration, and then I think we're doing the rest of the payments over 12 months.
Okay. And may I ask what the initial consideration is?
22,000.
22,000. Okay, that's not so bad, is it? And how were you going to finance that?
Just out of cash flow.
From another business?
Yeah.
Okay. And is there anything in the business like debtor book, like equipment? I don't know if that sort of business carries any equipment that you can place finance on later.
There's very little. He's already factoring the accounts, and vehicles, which is the main asset, are actually leased.
Right. Okay. Because my thinking was you put your 22 in, but you get it straight back out in 30 days in some way. So the question to ask yourself is this, and I realize there's going to be some legal fees. Do you think that the business will be able to cover the legal fees?
Yes. Yeah.
Okay. So it really is about 22,000 that you are risking. Now, if you lost all of that 22,000, it was never to be seen again, would that be a blow, or would you ride it out and just sort of?
No, we'd ride that out. Yeah.
So you'd put it in your current business as an investment where you lost money on an investment. So in fact, there's a slight tax advantage and so forth. Okay, fine. So you're at the 8-week point already. The danger is it starts to drag. And I think once you get past the 12-week point, you might lose your seller for this sort of deal fatigue, where maybe they win a new client, possibly, and they say, you know what, do we really need to sell? It could be a great year next year. So I would make sure that your deferred is somehow linked to either performance or a warranty around the numbers that they have given you. So if they've given you some management accounts that turn out to be absolute nonsense, then you could make a warranty claim. Oh, and that reminds me, I want to recommend a book to you. Let me make a note of that. So therefore, the deferred element, which is probably what, another 80?
No, 22.
Oh, right. Okay. All right. It sounds like you got yourself so you're buying, how much profit does this business make?
100,000 last year.
And you'd be paying like 44 for it?
Yeah.
That's all right. So I would be saying, how can we get this deal over the line? And will this be your first acquisition, Simon?
No, we've done a small one, but many moons ago.
Right. Okay. So this would be like good current experience. Yeah. Nice, fast learning curve. And probably give you the flavor to the appetite rather to sort of go for more as quickly as possible. So I would say, how can we get this over the line? Use the corporate structure that is always set out with a holding company and SPV, so it doesn't touch your existing business. That's very, very important. Don't give any personal guarantees, so you limit your personal exposure, and make the deferred linked to their warranty that the numbers they've given you are correct. You can bet your bottom dollar that they aren't correct, even if they think they aren't correct. So you probably won't end up paying that 22 anyway, because they warranted that the figures are correct, and they aren't correct, and they're usually correct. They're usually correct in a negative direction. Yeah. They're never better than they think they are, and therefore you buy the business for £22,000. I would say your risk is so minimal. I would say just go for it.
So how would we instruct our solicitor to proceed on that basis then?
Are you using John Andrews?
Yes.
Yeah. Oh, you are? Okay. I would explain to him what you've just explained to me, and I would imagine he would say a similar thing. You know, your risk is minimal. In a worst case scenario, it's not going to It's not going to damage your personal or your other business's finances. Therefore, let's just get this over the line as quickly as possible.
Okay.
I think it would be a conversation. I think it would be music to his ears, actually. You'd think, okay, we can just get this deal done. Let's get it all wrapped up in the next 4 weeks.
Great. Okay. Thank you for that.
So I'd be giving a deadline to your seller.
Okay. Thank you.
Let's see if anyone else would like to jump in with some comments on that, because I think that's a great case study there of around risk. While you're thinking, I can let me recommend the book that I don't know where I saw it advertised. It's by Simon Jordan, and Simon Jordan was the owner of Crystal Palace Football Club for 10 years. And I have to declare no interest in football whatsoever, but despite that, I still found it a really good. I found it a really good book. I had to flick across a few paragraphs that was getting a little bit talking about people I had no idea who he was talking about. But the most interesting part of the book, from everyone's perspective here, is about 25 pages in the first quarter of the book, where he starts, builds, and sells the Pocket Phone company, or the Pocket Phone shop, which I kind of feel have a vague recollection of in the late 90s. And it was around the time when, you know, people were getting their first mobile phone, and the industry was just going crazy. And it's really just a whole sort of sales machine of typically young people in mobile phone shops selling phones like crazy. And he built the business up, had a 50% business partner. The 50% business partner, and he started to have a relationship that got a bit rocky, as often these things do. And they had different ideas of how much they wanted to sell the business for. And the business partner said, if I am happy with X, and we never know what X is, although I think I know what it was, but if I get X, I'm happy. So they signed a deal where upon the sale of the shop, he was guaranteed that figure, and then, but nothing more than that, but also nothing less than that. He would get that figure. So the total sales value, and they sold to 1-to-1, which again, if you cast your mind back, was one of those early mobile phone companies, was 75 million. And I imagine the multiple was quite high. I would imagine that the multiple was about 20 on a 3.5 million profit. Interesting how cash starved they were right up to that very, very last moment. And I think that the partner got 10 million. So Simon got the better end of the deal there with his 65 million. Interestingly, 1-to-1 sued on the warranties, and over they wanted £6.5 million back. And I believe it was settled at 4.5 million, but it cost him $1 million in legal fees to get it from 6.5 down to 4.5. So he won by $1 million. And then the rest of the book is his ownership of Crystal Palace, where all of his money disappeared over a 10-year period, and he ended up with very little at the other end of it. And there was the whole 2008 financial crisis as well. But it's a really, really good book. Even if you just read those 25 pages about building the mobile phone and the whole process of selling, I think you'll find it very, very relevant to what we're talking about here. Okay, that's my book recommendation of the month. It's called Be Careful What You Wish For, I believe. But if you just put Simon Jordan into Amazon, you will find it. Very, very, very entertaining read. So any comments on what Simon was saying there about getting a deal over the line, about deal fatigue? Something actually for those of you who are in the process of an acquisition, you need to be careful it doesn't drag on too long. I think it's very, very easy for a deal to drag on too long, and then it just starts everyone starts to get tired of it. You'll be distracted by something different and new. They'll they'll be distracted by something and it all falls apart. So any comments on Simon's? Because I think that was a really good case study. Or maybe it was so, we covered it so completely, Simon. There is nothing to add. It looks like that is the case. Simon, good luck with that. Let me know how you get on. Have a chat with John in the next couple of days, and tell him you just want to get this deal done.
Great, thank you.
And he'll keep it deliberately simple, knowing that you just want to get the deal done.
Great, thank you.
Lovely, no problem at all. Yes, Rob.
Yeah, sorry, I was a bit slow to get it in there. So in relation to Simon's deal, we've had a deal bubbling away in the background where we signed heads of terms months ago, and we found the seller very unresponsive. Everything's just taken a long time. We've been rather hesitant to actually commit to actually appointing a solicitor in that deal, because we're not sure that he's actually really motivated to sell. And so what we've done is we've thrown a few things at him to see if he's actually going to take action. So that's something that we did, and he's not really taking action. So we think the deal is just going to fade away quietly. We're putting no energy into it really at all at the moment, but we've certainly not committed any due diligence from professionals. Yeah. Tim will want to comment on this as well.
Yeah, what we've done, the guys are right pain in the arse. What we've done is we've taken the DD pack that JMW have given us for a really large acquisition, and we've basically slapped it in front of him. We've changed the headings on it to his company. There's 10 grand's worth of his solicitor's worth of work to get all that information in. We've given it to him and said, we've made a data room. We've asked him to do everything, and if he fills it, then we know he's got a level of commitment because he started spending money. And if he doesn't, we'll just it's literally took us half an hour to change the document and set up the room. Okay,
so basically you've drawn a line in the sand. If he doesn't do that, then you're moving on.
Yeah, and we also know he over-egged his assets by about 100 grand. So we know we need to renegotiate. So we're going to let him do all of this work first, and then drop that on him. That's sort of the thoughts. So that's a way of just measuring someone's motivation by getting them to do a ton of work before you do anything.
Yeah, exactly. I mean, right at the point of signing heads, you can ask them who their solicitors are, and ask them if they could appoint them in the morning and confirm with you that their solicitors have been appointed. So because our guys will need to speak to your guys, and they can't speak to them until you've appointed them. So could you make sure you sign the engagement letter with them and agree fees with them in the next 24 hours so we can get moving on this? And you might say we need to get moving on it because we've got another couple of deals lined up, and if we lose our slot on this, then it's going to push it into the second half of next year. So you create a little bit of pressure there. Yeah, that's great, both of you. Thank you. Tom, hi. Good morning.
Morning. I seem to have had the bad luck with all of those above, as it were, today. Not today, but over the last 6 months. I've had one that I signed heads of terms. We were really good. It was in a hotel, and he was a very motivated seller. Got back to his office, and I sent him heads of terms in writing. Didn't hear from him. He went AWOL. 3 weeks later, he popped up and said that he got back to the office and he had resignations from his 3 senior people on his desk. So I didn't want. They're about an 8-man company in a digital marketing arena, and it was his 3
senior. So you had other things on his mind, basically.
Yeah, I think so. I think it was probably an indication that that things weren't going as well, and he got fed up, and I think they'd seen it, and so he went. And the other 2 that I worked through, and again, it's going back to Simon's point in timing, one just kept dragging on and really motivated, but it was 2 owners, 50-50, and one wanted out to pursue other things. And then once I started talking to them, very much like Richard was saying earlier, she started, the one who started the company, in her mind, I think she believed it was still her company, even though it was 50-50. she started getting excited about the future and, oh, well, maybe I'll stay on as chairwoman and all that sort of stuff. So eventually, I think her accountant, who had sort of retired from his practice and realized that he's got a pensionable opportunity working for her as a consultant, decided that he could do what I'd said, and they pulled out the deal. And I'm working with another one at the moment, a PR company, and again, 2 owners who one wants to stay, and she's 10 years younger than the one who wants to leave, but one who wants to leave has now realized that, oh, I can stay on as chairman. It's just
yeah. Well, what are they chairing? How big is it?
I think they see an opportunity. So I said, look, you know, it's not doable, because as soon as you stay around, everyone will look to you as the former owner. And I get an option.
Sometimes you got to say to people, look, you're either selling it or not. Yeah. You can't have your cake and eat it.
Exactly. But so what I said in there was, look, you know, and then she kept saying, what do you value it as? So ask your accountants to do an industry analysis of who you compete with and all the rest of it, and come up with multiples. But here's a very brief understanding. Oh, can you give me some numbers? And I said, no, I can't. You need your accountant to do that. Anyway, so what I think I've said in the end was, look, if you really want to grow the company that way, the only way that I will do it is on an equity earning basis, that I will give you 2 days a month at 10 grand a month and help you grow. And at the end of a year, if you've hit these figures, I now own 25% of the company. But I'm not going to buy the company and then have you two hanging around. So we'll see how that goes.
Well, I think you made your position very clear. They know exactly where they stand with that. So absolutely. Yeah, there's this sort of consulting for equity approach. I see people talk about this. I've never seen it really work in a very practical way. I think the principle is kind of good. If you have some sort of skills that you can bring to the business, and then you kind of you charge them for those skills, and then in the case that you've just given it, the example of, Tom, if they hit a certain growth target, then they have equity. Oh, sorry, you have equity. I think what happens, human nature kicks in to mess that up quite often, where they feel as though, oh, it's all very well, you know, Tom turned up at our office twice a month, but it was only twice a month. We were here till 7 o'clock every night, 5 days a week. We did all the work, and now Tom owns 25% of our company that we set up 10 years ago and we've worked hard at. That's outrageous. So they sort of go back on the agreement, and it just becomes very, very awkward.
Well, in my first company, I bought a company back in 1996, and I had been made redundant and went to work for this guy. And I said, no, I'm only going to come and work for you if I get an equity opportunity. And I became the MD. And I said that when we hit this number, I will have the rights to buy into the company at a higher rate. And 2 years later, he started saying, well, I said, no, I'll walk away now. And by the way, you're worthless. And eventually I bought the company. We were doing about $1 million turnover. I bought the company for his money. Because what I did was, on his balance sheet, he had his wife's car, his caravan, improvements to his property and all that sort of stuff. So we took those out of the balance sheets, and it was an asset purchase. And I grew the company from 1 million to 10 million in 3 years and sold it. So that's the process I would use for an equity earning, and say, look, I've done it before. I've done it twice, actually. The next company I did the same thing, and we sold it for.
Did you say the sector, Tom? I can't recall if you said the sector.
Well, I'm in the, I was a computer manufacturer then, but now I'm digital marketing, or it's really marketing. I'm a sort of marketing guy, but it's generally in the agency space. But I had a company that was like Zoom effectively, and we sold it in 2011 to Brother, the Japanese company. So for 8 figures. So that was interesting. But that was, again, it was a rapid growth. So I've got a process to rapidly grow a company, but I'm not going to give it away for nothing, just at some stage that I might be able to buy in. It's from day one, I have a contract to say, I will have these rights if we hit these figures. But that's really a secondary thing. But if I get so far down the road that I'm not going to sell, I will pop that up and say, well, look, if you really want to do that and you want to stay on, this is the only way I'll do it. And 10,000 a month for 2 days isn't too bad.
So were you here at the beginning where we were talking to Richard in the Netherlands about his digital marketing?
Yeah.
Yeah.
I've spoken to Richard before about this and said that, you know, it's a difficult scenario because as soon as they see that there's an opportunity and you can do it, they want to hang on. So
yeah.
So digital marketing is quite difficult. When I say difficult, it's a difficult space because it's a growing space and everyone thinks they can do it all and it's easy and there's whatever.
Well, the barrier to entry is very low.
Very low, but also it's very much a lifestyle business. It's usually creatives or technical people that start the company, but they're not business people. They don't really know about sales and marketing per se.
Yeah. Interesting. Who'd like to contribute to what Tom's just been saying? Any thoughts? Anything you'd like to add? Just tap that little yellow hand, and we can bring you into the conversation. Anyone else in the same space? Apart from, we know Richard is. Anyone else? Digital marketing, very popular. Very popular. Downside, I suppose, is typically so much of the work is done by young people who might have a different approach to work than their older, more mature counterparts, and it becomes a people management business, where you've got people doing not very much but wanting to be paid more and more for not doing very much. Any comments on what Tom's just been saying? Again, Tom, we've covered it. We've covered it all. Thank you so much. Okay, who'd like to go next? Anyone else for anything else? If you were right here at the beginning, you'd have heard me say that we only had the last meeting 2 weeks ago because of the way half term falls. So I'm just impressed that so many people showed up for this 2 weeks later, which is great. Hi, Christina. Good morning.
Hi, good morning, everyone. I missed the first half an hour of everything, so apologies. I'll rewatch all that.
Yeah, we were talking about should the seller, for the first half hour, so I made a note of this actually, we were talking about should the seller stay in the business. That was the subject. With very different opinions. So
so I'm looking at a totally different business that's come back to me. It's only a small one. It's not a sector that I want to be in particularly, but I do see that there's a couple of different opportunities. Now, I've got a friend who's in that sector already, and she's working really, really well. And I've talked to her before about it. And I'm thinking about bringing her in as the main manager or like a business partner. But because she's well into that sector and she's very good at customer facing, and she's very good at growing her own business. She likes, every time I see her, which I see her once a month, we always have a good chat, and we're on the same wavelength, and she's always fascinated with what I'm doing, and she's always said she'd like to work with me. So because this opportunity, I had this opportunity before, but then I wasn't really interested and it's come back. Now I'm actually thinking, why don't I just go for it and actually bring her in as a business partner and maybe give her up to even 50%, where I'm more about the business development side, and then she knows that sector well, and then she can develop it more so. But I'm just wondering whether 50% is too much, whether I should just go in with 10%. She's already got her own clients and customers, and it's about, I haven't spoken to her about this in depth yet, but it's whether she can bring those clients in somehow, and then how we can grow and develop it further. Now, I don't actually want to work in that sector, but I wouldn't mind being the business developer person.
What business is it, Christina? Just so we can.
It is hairdressing. Okay. It's hairdressing, which is why at the beginning I looked at it, loads of them came to me, then I realized it wasn't actually what I wanted to do. But this particular hairdressers is the only one in the village, and the village has grown and grown and grown, so there's hardly any competition. And she can bring in lots of different things, and then I'm thinking of bringing in different elements, so not just the salon, but also education, training, own products, and different lines of things that she can help develop as well. And it would almost be a sideline business. So although it's taken me off my focus of what I'm actually doing with my property and my construction, it still is I see it as a good opportunity. So I'm just interested to hear the views of whether.
Let's hear some numbers then, so we can again get the picture, because obviously these types of businesses individually are usually quite small. So what's the size, Christina?
Yeah, so it's really, really small. So the net profit is probably only about £20,000 at the moment. But what's happened is the person that owns it, she's actually gone to work, so it's gone to live abroad, and she has her brother running it, who's the hairdresser, and she's taken her foot off the gas. So she's got this lovely salon, and nobody's running it, nobody's paying attention.
The premises? Does she own the premises?
No, it's rented, but it's a really low rent. So it's a really low rent.
All right. So we've got so many things here, so many different angles to come at this at. So who'd like to go first? Who wants to jump in with a comment on this? Come on, guys. Alison, good morning again.
Good morning again. And I'm sure we've talked about this driving down in the car together. But there we go. You've hummed and hawed about this one for a wee while, but it is something that you've wanted to do to get your business buying going, even if it isn't in the right sector. Personally, I wouldn't be offering somebody 50%, and especially based on the conversation earlier on, but even 25-30% might make a difference. But I think there is an opportunity here, especially with your friend, having her on side and having her run the business and grow it, for you then to help on the business development side, and maybe even start creating something that your friend could buy off you in time.
That's good. Yeah, that's a good idea to actually sell to her later. Yeah.
Yeah, that's good. Thank you. Thanks, Alison. Rob?
Hi, Christina. Yeah, just interested to know, obviously she's a hairdresser already. Presumably she's got a salon of her own somewhere else?
No, she was an air hostess, so that's why she's got good customer service, and she's very, very personable, and also she's very good. So she's built up a mobile hairdressing because she came away from that to have a family, but she grew it so quickly to 100 clients in less than a few months. And she's so, she's so much in demand. So as a person, she can attract that, and she's very good at what she does.
Okay, and geographically, where's her area that she's got all these clients? Does it overlap with the village where the salon is?
It's kind of like next door.
Right. So what would happen?
So it's not too far away.
Yeah. So what would happen to all her clients if she was then?
Well, this is the other question that I'm kind of like thinking to myself, because she's a person that probably has never believed in herself and that she can do things. So our conversations inspires her, and it makes her want to grow. So therefore, the question would be, if I took on this salon, how she can incorporate her clients into there, how would she do that? And would she teach other people to come on board? And how would I cost that into such a deal? Would I say, okay, for every client you bring in, then we'll give you X amount of money, or do I just say, you keep those clients separate, and then we have this business separate, which I don't think would work. So I'm just in my mind thinking about, how am I going to pull this together? How am I going to lay it out for her? How am I going to incentivize her to come and join this team, or with me and her?
Okay, thanks. And what would be your strategy then going forward with this sector? Because obviously you're looking in other sectors predominantly. So is this going to be like
So
quietly in the background, or do you think because once you start in this sector, if you go on a buy and build in the sector, then you've got to commit to it.
Yes.
So it's some significant time.
Yes, significant. Yes. For me, because it's such a small business at the moment, so it's not like a multi-million-pound business. However, it does take time. So for me, I see that I can grow and develop that business in different ways than just being a standalone salon. Just things like introducing different revenue streams. So for me, I would almost be an advisor, the business developer. So a meeting once a week, just to sort of like, I see myself as being like a consultant that comes in, we talk about the business, and then she puts it all into action. So as far as time goes, I see myself being more of just a consultant, not hands in, but then looking at the numbers, seeing how it's driven, but not spending too much time in it. Maybe 1 hour a week, 2 hours a week discussing. And whether that's realistic, I don't know yet at the moment, but it's a small business that could expand. So the more it expands, obviously, the more time, but it isn't going to be my main focus. It would just be almost bread and butter kind of money in the background.
Yeah, so you're not thinking about sort of going out and seeking more businesses of the same. You're just thinking, just acquire this one and just let it.
Yeah, maybe on the side, and then with her as a business partner, she could drive that side, but use me to sort of like bounce the ideas and to help it grow further. I would let her try and do that. So the reason I suppose I'm raising it is it's kind of like just distracting me from what my main focus is, but maybe it's still worth doing, because at the end of the day, it's a business. It still has potential, can still grow. It's not going to be massive, but it's still, I think for me, I get quite an excitement from growing and developing a business, whether it's small, medium or large.
Okay, so if I could just jump in with a couple of questions then, and thank you, Robin Allison. So I would say, again, same question really as I asked, I think it was Simon earlier. What is your risk?
The risk is my time, and my risk is the time, because it's not going to cost me anything. I think I can literally, she'll probably only want a few thousand for it, which I can defer anyway. So my risk is my time and that it fails. The risk is the lease, the payment on the lease, and that's really just a couple of £1,000 a year. So it's not even a big risk.
It's all trading through a company at the moment.
It's a sole trader. So what I would actually do is actually change it over to a limited company, just by whatever the assets are, and just do an agreement.
Asset purchase, and your
asset purchase
would buy the assets. So you're not so the change would happen as a result of the acquisition, wouldn't it? So you'd have your SPV with the so you've got a challenge with the lease. So basically it's either an assignment or a new lease.
Yeah, so we've discussed that already, and the landlord seems, from what I've only heard from her side, so it just seems to be a straightforward. They're quite happy to change that over as it currently stands.
So at the moment, because the lease is with her personally, it's effectively personally guaranteed.
Yeah.
Okay.
Oh, I don't know if she's got a personal guarantee on it,
but it would be because it's with her personally.
Yeah.
So there is only one entity for the landlord to go to for money, which is her person. So that is
so it would be a new lease. It would be a new lease or assignment of the lease. Yes.
Yeah, but the new lease would be with your company, with your SPV.
Yes.
Okay. So this changes the perspective from for the landlord. At the moment, the landlord is going to get his money out of this woman, whether she likes it or not, because it's her as an individual who is liable to pay the bills.
Yeah.
Okay. But moving over to a company, he might not feel quite so confident, because you could just close that company and leave him with rent arrears.
Yeah.
He might ask for a personal guarantee against the lease.
Yeah.
And the answer has to be no.
Yeah.
Okay.
I think the level of rent that is currently being paid kind of like, I think it's an old lady that has the building, that owns the building. So I think the level of the rent that she currently pays almost says to me that it's not sophisticated and that it could possibly be not as challenging as maybe some other more.
Yeah, but she's going to have a solicitor, because you don't do things like that yourself. So it's the solicitor you're dealing with rather than the landlord herself. So
yeah, okay.
But because it has to be, because most people don't know how to register things at the land registry, don't know how to, I wouldn't know where to start to write a lease document. So that is why we need solicitors specifically for the property side of things. So what's going to happen is the solicitor is going to say, look, we've currently got effectively a personal guarantee from our tenant. We would like the same from you, and your answer has to be no.
Yeah.
So this whole deal might stop at that point anyway. Okay, so I'm just flagging that up as a because the property side of things can be way more challenging than the business side of things. So that might be a situation that you encounter. So that's the first challenge. I certainly wouldn't do a 50-50 type arrangement with this friend. I would let her earn her equity over time. Maybe start with 5%, but you need to be able to take it back if things go wrong. And quite often things do go wrong, because the capacity that you know her in now is going to change, and now you're going to be in business together, and you might have certain standards or certain expectation is a better word, certain expectations that she doesn't meet. So you might want to ditch her at some point, and you need to be able to do this without it damaging the business or costing you any money. So therefore, that shareholding should be linked to an employment contract. And if the employment contract terminates, then the shareholding is bought back for £1. Now, then we've got to look at the employment contract. So the employment contract will have good leaver as in leave the business, and bad leaver provisions. So if there's gross misconduct, for example, then you can exit her and there's no problem. If you just decide that you do not want her anymore, then you would have to go through a different process, and that might affect her ability to hold on to the shares. But this is where an employment lawyer can help you. Annoyingly, employment lawyers make things very, very complicated, far too complicated to my mind, and basically put you in a position as the employer where you can't win. And that always seems to be on the side of the employee. But these are all the things to think about in this project. The good news for you, though, is if you can buy the business for nothing, then your financial risk at that point is nothing.
What do you think about my friend bringing in her clients, so I'm bringing the business or the salon and effectively that, which hasn't been marketed, and we can then develop. She has her own small business currently, and I'm thinking about how she can incorporate that, or should I just say?
So why didn't you tie that to shareholding? So why didn't you connect those two things? So because people can say all day long, "Oh, my clients will follow me. They'll go with me anywhere I go," but they might not. There's no guarantees. You can't make those clients come and have their hair cut at that salon. So therefore, it's all done on a little bit of a wing and a prayer that it may or may not happen. So I would be assessing whether it happened or not 6 months, 12 months down the line. And that is where her equity kicks in. So what does she get in return? She gets the share of this larger business.
Okay. So by sort of like bringing her on as an employee, which I never really thought about, effectively, it's about negotiating how much she would get paid on that as an employment contract.
Because I bet she would want that. Because if you said, look, I'm not going to be paid a salary, I'm going to get dividends, which is a distribution of the profit that the business makes, she might say, what happens if the business doesn't make any profit in its first year? I can't live on thin air.
Mm-hmm.
So she'll want something out of the business. And if it isn't a distribution of profit, then it has to be a salary.
Mm-hmm.
There's no alternative. I mean, she could take a loan from the business, I suppose, but at some point that has to turn into either a dividend or salary at some point.
Yeah.
In the old days, those loans could sit there for years. Happy days, right? If you did this sort of thing years ago, happy days. Those loans could sit there in the accounts for years. Alison, did you have your hand up a moment ago to?
I did. It was kind of more of a practical thing than a strategic thinking. It was more to do with her clients. If your model is renting out the chairs for other hairdressers, as loads of salons do, then she rents a chair. So if her clients come into the business, she gets the chunk of money. You get money towards the, covering all the electricity, all the other stuff. So it depends on the model that you're using for the hairdresser as to maybe how she brings her clients over. So it was just a small thought.
No, I wouldn't do it. I didn't want to go down that rental chair basis. I think it limits so like how you can expand a business like that.
But if I could, because obviously I've got to know you quite well, Christina, over the last year or so. I would wonder whether this is the best place for your abilities.
Yes, and that's probably why I raised the question as well, because I can easily get sucked into different things, because I always feel I can add value. So this is kind of like something which is quite small, but could work in the background. And yes, I'm going to put my efforts into there. Should I put my efforts in there? Or should I just think it's actually not where I want to be? I shouldn't be wasting my time. I should concentrate on the bigger picture, on what I actually do want to be. So that's maybe a question for me more so.
Yeah. And sometimes the smaller businesses can be quite draining because you don't have a management structure, and therefore all the sort of the decisions default back to you. And the smaller businesses live on more of a sort of a tightrope of profit and loss, and that tightrope very, very finely. And as we all know, hopefully we all know by now, it's no more difficult to buy a larger business than it is a smaller business.
Yes.
And sometimes it's a lot easier to buy a larger business than a smaller business.
Yeah, and I think also with this, it would be quite good to sort of like grow and expand that. It would be challenging, and then the things I'd overcome would also help with larger organizations of what I want to overcome. It's almost like a practice. If I make mistakes in a small business, it's not going to be as costly as making mistakes in a large business. No. And however, I do feel confident.
Yeah. The other thing everyone has to consider is, do you want to buy a solid, profitable business that's going to make money from day one without you doing anything because it's already existing, solid and profitable? Or do you want a business that's could be a lot more profitable, but you've got to fix it and you've got to do some things and add some product lines and do some work on it? And basically, without realizing it, you're creating a job for yourself. And fixing businesses can work and it cannot work. I mean, with some of mine, some really went so well, and others, oh my goodness, they didn't. So you've got this sort of balance of, it's so much easier to buy something that's already productive, and I would rather anyone pays a higher consideration for a for a solid, profitable business that's already productive, that will continue being productive and doesn't require you there, than a lower consideration for a business that needs a lot of work. And I love, I've done all right with turnarounds, and I kind of enjoy it to a certain degree, but it can also be a bit uncomfortable. It's not everyone's cup of tea. So actually buying a business that's making the money day in, day out is better.
Yeah, I know what you're saying. It's because I know I can get it for nothing. Yeah. And I know I can bring somebody on, and I know I can sort of like grow and develop it. And it's almost like, well, it's just there, isn't it? And it's that kind of thing.
Yes. It depends really what your financial motivations are. Because if your financial motivations are up here, this might only get you like one step up the ladder.
Yes.
And you might sort of, like some of the people on the call today are going for the multi-million sizes, because it gets them where they want to go faster.
Yeah.
And on my screen, Rob is sitting directly next to you. Hi, Rob.
That's curious because it's directly next to Christina and mine as well. Just one quick question. Are you thinking about this business for yourself, or are you thinking about it to give your friend some income?
Do you know, I'm thinking about this business as a personal growth for me, because I see myself as like doing business consultancy anyway, like further down the line. So I almost see this as a personal growth for me, to be able to turn this around or move it up or expand it and develop and grow it and have more structure and something solid that I can use as a testimonial almost as well.
So I mean, Jonathan obviously alluded to it there, and you used the turnaround word in that conversation.
Yes.
So what you're saying is then that this is a turnaround, because essentially there's a failing salon. You're thinking, I've got a friend who could do the some of the work, and then I can do the rest. But like Jonathan said, that's probably going to take more of your time than you imagine. And is it going to distract you from the bigger game that you want to play?
Yeah.
And you've got to think also about how you can leverage the business that you buy into your sort of your next deal. So if this business is making £100,000 a year, then you can go and borrow 200, 250, and then you can use that 250 to buy the next one. And then if the next one is making 200, then you can borrow 400 to 500,000. And then with the next one is making, say, 500, you can borrow 1.5 million. So you can scale up quickly. But if you went to a lender and said, I've got this business that's been making £20,000 as a sole trader business, they immediately say, well, I bet the sole trader was doing most of the work. That's immediately what they'll think. It doesn't have any. It's kind of like you're not going to get anything. You're not going to borrow anything of any real value to move you up that ladder as quickly as possible.
Yeah, I get you.
Don't forget the one thing that we've all got a finite amount of is time. So anything that gets us where we want to go as quickly as possible is going to be good. I mean, Harry, you bought a barber shop, didn't you?
Yeah, hi Jonathan. Hi Christina.
Hi.
Yeah, following on to what Jonathan said, obviously I've got to know Christina over time as well. Just out of interest, where is the salon? How far is it from where you live? Or
20 minutes drive.
Okay, I mean that's a bonus, because if it was further away, because when I bought my two, the bonus is they live, they're not too far from where I live. And in the early days, they do take a lot of time, and it comes down to your time value. So, I mean, I did it to follow Jonathan's process and to see if deals can be done that way, and they can be. Would I do it again with the salons? Probably not. Again, it just comes down to your time. You're busy with all your other businesses and everything else. And if it links into that, great. But to go ahead with this, I just from your answers as well, I can tell that you're not too. I think you're trying to find reasons to get it as opposed to not.
Yeah. Thanks.
Yeah.
I think we're all kind of saying the same thing.
Yeah.
Jump in here and say the same thing.
Yeah.
Yeah. Okay, that's fine. Thank you. Anyway, thank you for your input, because that's what it's all about, isn't it? And I think the original question was all about how to bring a partner in and how to structure that. And yeah, thank you very much.
It went beyond the scope of your question. You got more than you asked for. Right, Christina, thank you. Okay, we've got 9 or 10 minutes left. Who's got something that they would like to throw into the mix in the last 10 minutes? So it's got to be something that's reasonably easy to understand and reasonably straightforward. Who has got something? Anyone for anything? Actually, could I? Okay, let me. David Young, tell us a little bit. So you work helping people exit, right? Is that correct?
Yes, that's right.
So what do you see, David, as the what holds people back on their value? What prevents them from getting the value that they would like to get when they sell?
Definitely with small businesses, key person dependence, because the buyer's worried about the risk that the business won't carry on and produce the goods with the seller either out of the picture or not pedaling so hard because they're maybe still in the business but now, have received significant amount of money. That's one thing. That's probably the biggest thing. And then the other thing with small businesses is often the lack of convincing historical financials, lack of projections, lack of clarity around how the business is performing financially. So yeah, I agree entirely with all your comments about the value of working with accountants to get the thing sort of understandable and comprehensible from the buyer's perspective.
Yeah.
And then I think often, a lot of owner managers, we truck along trying to make profits, trying to grow profits. We should start thinking as soon as possible, and you can't start thinking early enough about the exit, who the likely buyers are, what they're going to want more of and what they're going to want less of. Because it's not just a question of, growing profits. It's a question of getting into the crosshairs of a big buyer who really badly wants what you've got. And profits and profit growth is good, but sometimes they can be at odds.
Yeah.
I remember selling a business. It was a business. It had a circular knitting, a tubular knitting technology. It was owned by private equity. It was a Danish company, and we wanted to, and it produced a sort of sanitary solution for old folk, where you had a sort of a pant, which was the circular knitted thing, and a disposable nappy, effectively. And basically, it was a sanitary solution. It was a healthcare solution, and should have been sold at a high multiple to a healthcare company in the States, for example. And but they used the tubular knitting technology to produce fishnet tights. And I couldn't persuade them to close the fishnet tight production because I reckon no healthcare buyer would want to get involved in having to close that down in a foreign acquisition, and would also feel ridiculous, with the press coverage about what the acquisition did. But no, the seller was determined that they didn't want to forego something that was producing 10 or 20% of the profits, even though I think they would have got a much higher multiple for the 80%. And in the end, they were unable to sell the business because none of these foreign healthcare buyers wanted to be dabbling with fishnet tights or wanted to have to close something down day one in a foreign country.
Yeah, well, they could have split the business into two entities and actually had two sales.
Well, possibly, or they would have just been better to close down the bit that the buyer didn't want.
Yeah.
So I would say, make sure you're focused on who your likely buyers are, what they want more of and what they want less of, and give them that.
Well, is it not then? You summarised it so well there. Is it not there then for the easiest thing to sell is something that someone already wants? So
absolutely.
If you know what your buyer wants, then create what they want.
Yes. And your fundamental premise is you're working on a brilliant arbitrage. You know, I mean, there are a lot of private equity firms that don't want anything with EBIT of, say, less than, or EBITDA of less than $1 million. And they'll pay multiple, they're competing with each other, and they'll pay multiples of 6, 7, you know, or 8 times that. Whereas you can buy things that have got EBIT of $500,000 for multiples of 3. So you put 2 or 3 of those together and you double your multiple simply by aggregating them. Exactly. So in that sense, you're giving private equity what they want, and it's dead easy.
And you're doing the work that they don't want to do, and it's outside of their thesis.
Yes, because as you very rightly said earlier, you know, doing a bigger deal is just as much work as doing a smaller deal. And so they know that what a deal costs them, and they're simply not willing to go into deals that cost them, you know, that deals values that are less than, you know.
Professional fees are so high on these.
Yes,
that,
yes.
You know, if they're spending millions with KPMG, then the business value has to be sufficiently high, and it's got to move the needle in their fund.
Exactly. So they set their thresholds, which are a bit arbitrary, and if we're willing to operate to put together groups that offer them up what they want, they'll buy it. You know, even though they could be buying at much lower multiples if they were willing to go smaller.
Yeah. Yeah, absolutely. But it's easier to buy that larger business from someone like us who's gone to hard work for them. The hard work being gone out, had the meetings, put the deals together, funded them in whatever way we're going to fund them, and then put them together. I think it's very important that they're put together into. They're not just they might be trading separately in separate legal entities, but there's a cohesive business there. You know, all using the same financial systems, for example. So you've actually got real-time data rather than, you know, this one uses QuickBooks and this one's still doing it on spreadsheets and this one uses Sage. So that sort of consolidation and integration, you know, being able to sell something that's fully integrated and fully consolidated. Otherwise they feel as though you've only done half the work.
Yes. The other thing I'd say, particularly when selling to private equity, is they're thinking about their exit a few years down the road. So they're thinking about what the growth trajectory of your business is going to be several years down the road. So it's worth spelling out the growth avenues that you've got, even though it feels speculative to do so, and you may not be able to do it financially. But, you know, don't underestimate what I call the diamonds in the drawers. Because, you know, a lot of the buyer world out there wants to focus on our last year's profits and give us some measly multiple of that. Whereas you can get really good results if you can excite strategic buyers about the potential your business holds for them. So it's worth communicating, articulating the longer term potentials and the growth avenues, even though you're not in a position in terms of your finances or your interests or whatever other constraints, because every business is run under constraints. But the thing is, think away the constraints and present the story about what the business could do, sort of downhill with a following wind, but with the investments of time and money that other people could give it, and try and get people to compete for that. So, you know, think big, brainstorm, and you can use probability weighted cash flows to communicate potentials which seem highly speculative.
Mm-hmm, mm-hmm.
You know, that's what I learned when I was dealing in the biotech sector. You have whole biotech companies that have got portfolios of compounds that are years away from being into the market, but they still trade at enormous values because the biotech companies debate with each other. You know, what are the probabilities of getting to a blockbuster drug 10 years down the road when you get through all the regulatory challenges? And these things change hands for hundreds of millions, billions sometimes, even though there's nothing that they're actually selling. Now, I used that technique to sell a toilet paper company, from the sublime to the ridiculous, but, you know, based on a continental rollout plan for a UK company that had gone ex-growth. So you can apply probabilities to future growth potentials, and then give the model to people and say, hey, you put in your assumptions. You know, it's not an exact science what the value is here, but let's build a model and
the mature run rate EBITDA. So, you know, we're here now, but our growth curve is going like this. So So we're this way along the growth curve, and we're going to be selling it to you on this value here that's actually 2 years into the future. It's quite remarkable that people do it, but they do. And let's just bring in Tom for just a couple of closing comments. Tom, David, that's really helpful.
A really quick question, David. You mentioned diamonds in the drawers. Was that a euphemism to that company that made incontinence pads?
All right.
No.
That's just the perfect closing comment. I love that. That's great. Do you mean say are you referring to the Acres of Diamonds story, David?
No, I wasn't in particular. I was thinking more of, you know, diamonds in the rough. I mean, I think every company's got lots of potentials that are, you know, they're sort of they're in the back of our minds, and we hesitate to communicate them when we're selling because we don't have you know, precise financials for them. But they're worth articulating. These potentials are worth articulating because they may excite buyers.
Yes. Yeah. Absolutely. Great. I think that's a great way to finish today's session. Thank you very much, David, for
pleasure
for that last 10 minutes. Much appreciated. So, ladies and gentlemen, that 2 hours flew by. That was so good. Thank you very much for your input. So we started with a blank piece of paper with this right at the very beginning, and we filled it with some great conversations and great points. So all of you have a great month. Have a great week. And you can unmute your microphones to say goodbye. I think that's always a nice way to finish. And
thanks, Jonathan. Bye.
Thanks, Jonathan.
Okay. Bye, everyone.
Bye.
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 Bye. Bye.
Bye, Jonathan.